Thank you for making your way to Funan this morning before the shops open. And I think that's the whole plan, because when the briefing ends, it would be time for brunch, and you can also consider doing some shopping before you head back to work. I'm sure Tony would be very happy with this arrangement, right, Tony? So Tony is the CEO of CapitaLand Mall Trust, of which Funan is a portfolio asset of. And my name is Grace. In case you do not know me, I'm the head of investor relations for CapitaLand Limited. And before we start our program proper, I would like to ask all of you to join me in a round of applause to welcome some new members of our senior management team. And of course, I'm referring to members from Ascendant Singbridge who have just joined us. Please give them a round of applause, please. It's Jonathan, yeah. Okay, thank you. We're officially one. Yeah. Okay, out of curiosity, how many of you here are in Funan for the first time? Can you put up your hand? Okay, not many, so that's a very good sign. Okay? And who can remember how Funan used to look like before redevelopment? Okay, I think many of us will remember Funan as the IT mall. And I remember when I was dating many years ago, and my husband would, ask us, let's go Funan. And I would like, no, because that to me is not something fun. I don't want to spend 3 to 4 hours looking at computers and gadgets. And that is why I thought it would be interesting to share with you feedback from one of the fans of Funan, who also happened to be a shareholder of CapitaLand. So Stephen Chen, he has kindly given us permission to share his Facebook post. I'm going to read that to you. So Stephen says, 3 years after the old Funan closed for redevelopment, the new Funan reopens, and it looks great. The new mall still brings joy as I wander down the corridor checking out the latest IT gadgets and camera gear. But this time there is so much more than just IT. Like the Tree of Life, which is right behind me, the urban farm, the rooftop garden, super high rock climbing walls, and many other kinds of retail outlets, and lots of spaces to simply stop and observe all that is happening all around me. And there are many more food choices than before. So great job, CapitaLand. So thank you, Stephen. Funan was where I used to spend too much money and collect most of my Capital Star points. I guess it will soon be where I do so again if the wife permits. And I think Stephen's wife would be very approving of this. And I also like to mention that Funan is not just a mall, right? For people who haven't been here, it also comprises of 2 office blocks and CapitaLand's first co-living space, Live. So on your way in, you would have received a promotion coupon, a special discount rate, because we would like to welcome you as our first guest to Live when it opens in September. So please utilize your coupon and make your bookings for Live. And I guess I can go on, but I think we need to come back to what we are here for, that is CapitaLand's first half 2019 financial results. And before I invite my group CEO, Mr. Lee Chee-Koon, up on stage, I would just like to say to our webcast audience, people who are tuning in, good morning to you. You can join us by just leaving your comments or your questions by clicking the Post Question tab. And with that, I'll invite Chee-Koon up on stage.
Morning, everyone. I have no slides as usual, so just focus on me. Thank you first and foremost for joining us for this event. This is a break again from tradition. For those of you who have been following us on all our results briefing, it's usually done in Capita Tower. So the first time we decided to do it outside of Capita Tower, we chose this place in Funan. It's quite an open area. To be honest, there was a bit of concern because some of our colleagues are worried, saying that are we going to get interference from shoppers, from retailers, from loading and unloading trolleys, and affecting the results briefing. Well, I think we decided to take the spirit, you never try, you never know, are we going to try something new? And it was in the same spirit that we took, where we decided to redevelop Funan. Grace alluded to what it looked like previously. Today it's very different. In fact, when I first took over, towards the end of last year in December, our committed occupancy was around 60% because it is something new. It was something new for us. It was something new for many of the retailers as well. And we needed to make sure that we carry the retailers along, getting them to upgrade, to change their concept, and be prepared to come along with us in this journey. And well, the team worked extremely hard. Must congratulate Anthony. Is Augustine, are you here? Where are you? Yeah. Congratulate to Augustine and all his team members for working very, very hard. The Funan opened really well. Not just the crowd, but if you have chance, spend some time, talk to the retailers, talk to the retail assistants. People are happy with the outcome, with the shopping that is actually taking place. And that's what we believe in, trying something new. And that's even before the Wild Rice has opened and before the new co-living concept has opened. I believe that once all these components are up, you're going to see a lot more excitement for this development. So that's really what I want to say about Funan. And the reason why I took some time to set this backdrop is also to explain and to reassure you that CapitaLand is we're in the midst of undergoing our transformation. Many of you who go for results briefing hardly get to sit on stairs, I would say. It's going to be different for many people, including for us. The future, the technology is changing many of the industries. It's going to make many people uncomfortable. But as a company, you will see us changing. And it was in the same spirit that we decided to announce the merger early part of the year with Ascender Singbridge. And at a point in time, I said that you can announce, you can do all sorts of merger and acquisition transaction. The key success for a transaction of this nature is how successful you can integrate the teams together. Our team focused very much on the organization structure and the people issues. And we wanted to make sure that by the time the deal was completed, which was at the end of June, everyone know who their bosses is, they know what their job is, so that when the day the company turns operational with the combined entity, everybody will just focus on the work. And we demonstrated by announcing, I think to the surprise of the market, the proposed combination between Sanders Hospitality Trust and Ascot Residence Trust. I think everybody knew some kind of transaction was going to take place. Many people were just surprised by the speed. And that could not have been possible if the two entities were not well integrated. So we spent a large part of our first half of the year focusing on the transaction, on the merger. But of course, we spent a lot of time to make sure that we continue to run our business, evident in the results that was reported. I think Resi sales continue to do well in China. Malaysia, we did quite a good job, thanks to Ronald and his team. Even for one per bank, today we have sold about 203 units. It's not a bad number given the state of the entire environment. In terms of all of you are familiar in terms of the opening of Jewel, very well received, well done, and Funan, of course. And we're also very focused in terms of the capital recycling. Earlier in the year, I stressed that we wanted to make sure that we focus on divesting our non-core assets in cleaning our balance sheet. We managed to sell out our JV with Mubadala in Abu Dhabi. That took some time, okay, but we were very focused. We wanted to get it done. We also exited from StoreHub. It was a business that we did not believe that we could scale it meaningfully for CapitaLand. It could work for other people, it just didn't make sense for CapitaLand. At the same time, we also divested our stakes in CCRE, which was a listed entity in Hong Kong. I mean, we have been a cornerstone investor for many years, give us good returns, but we just felt that it wasn't the right use of capital in the longer term. We focus and we get it done at a price that was significantly higher than what the share price was traded at that point in time. So there was a lot of focus on capital recycling. And of course, apart from non-core assets, we focus on recycling our assets into the REITs, as you can see, into CCT, into CRCT, into injecting assets into our Cap 1 fund, which was our first discretionary fund, and also setting up our debt fund in early part of the year. So many things are happening. I mean, the company is moving extremely fast, but of course, outlook is uncertain. US-China trade war, you saw how China decided to weaken its currency. Many of these forces are beyond our control. What we need to do as a company is to make sure that we focus on the execution, sharpen our focus, continue to deliver products and services that the customers want, continue to push on the innovation side, continue to make sure that we sell our products, we drive rental growth, and continue to make sure that we recycle. As compared to many of the competitors and other developers, we have more takeout vehicles, more REITs, more private equity funds than many of our competitors, and that gives us, I would say, much greater optionality than many people in recycling stabilized assets. So I believe that as long as we focus on our key strengths, focus on where our competitive advantage is, continue to build our capabilities, attract good people, I believe that we should be able to ride through any types of crisis. And in fact, there was always a famous saying, should never waste a crisis. Make sure that we are well prepared, strong team. Make sure that we recycle, have enough capital so that we are ready to take positions during a downturn. So that's all I want to say for my opening. I leave Andrew, who has a lot more slides to share with you in terms of our first year results. Thank you.
Morning, ladies and gentlemen. Thank you for coming. Tony, thank you for lending us your mall for a few hours. I still see some ties in the audience. There's a no tie policy at Funan. And you notice senior management has also taken the jackets off. So this is part of the transformation that we are undertaking. I'll take you through some of the key themes that we observed in the first half of the year, as well as underlying financials. And we want to save a lot of time for Q&A. Okay. I think this was the slide we showed you when we first announced the transaction. The end result is as follows. We are now a 129 billion AUM company, 25% increase from CL 2.0. What I'd like to leave with you is, for our largest country, we are now down from 49% to 42%, namely China. For our largest sector, we are down from 38% down to 31%. So there is a theme of increased diversification that comes with this increase in scale. And in an era where uncertainty is high, unknowns are high, we believe that diversification through different core countries and core products gives us a sustainable competitive advantage going through this high period of uncertainty. Chee Koon talked a lot about our focus and our resolve coming with the capital recycling we wish to undertake. So I just again, couple of key buckets here. The first bucket are the assets which are non-core to us, StoreHub and CCRE being on top of that. And this year to date, we've divested close to $1 billion of non-core assets. The second bucket are assets which we like, but we believe logically belong to our REITs and our funds. And here is a list of, again, very well publicized assets that we have either announced or completed into our REITs and our funds. Gross divestment value year to date is north of $2 billion. Okay, and this is growth of funds under management. Our REITs themselves have been busy recycling their own capital. Here are two good examples. Ascott Raffles Place, again, exit yield of 2 cap, reinvesting some of that into an EBITDA yield of 6+ cap in Citadines Connect. And Capital Mall Saihan through CRCT, flipping that through an asset swap into Yichuan Mall. Okay, so good examples, again, of our own REITs following through on their plans to recycle capital at an accretive level. Our annual recycling target of 3 billion, we are already past that as of the halfway mark. The other key theme I like to talk about is resilience. And resilience is something that people throw around, but one that I think we really believe we have. So if you look at our retail portfolio, both in terms of NPI, in terms of same-store sales, in terms of occupancy rates, in both of our core retail markets of Singapore and China, we are seeing year-on-year growth. And I think that is a testament not only to the operating excellence, but also the location, the network effect of where our malls sit. And the one that you're sitting in today is a great example of that. Residential core market in China, we are seeing good sell-through rates, north of 90% in the first half. So everything we launch, we are more or less selling. In Malaysia, we are back in KL with Desai Park. That has sold very well. North of 70% of the total units have already been sold. That's a top-up in 2023. And of course, One Pearl Bank, as Chikun mentioned, 203 out of 280 units launched to date are sold. So good results out of our opportunistic focus on projects where we believe there are good locational attributes, good iconic attributes. Lodging has been very busy. This is a global business. I think year to date, we have more than 40 properties announced, over 8,000 new keys that we will be putting into the system. Year to date, we opened 19 properties with more than 2,500 keys. Post-combination, we are now north of 110,000 keys, including Ascendas Hospitality Trust, and we are well on our way to 160,000 keys by 2023. In fact, I wouldn't be surprised if that target gets raised soon. But again, this is about growing the global platform, signing new strategic alliances and investments, for example, with Tausia, going into the rest of Southeast Asia, and new brands and product offerings, like Funan Singapore being a great example, opening in September 2019, hopefully in time for F1. We talked a bit about the merger of, two of our hospitality trusts. Sorry, I'm losing my voice. There's some media today. So this will create the largest hospitality trust in Asia Pacific. Okay, this gives Ascott the ability, or rather CapitaLand Lodging, the ability to recycle our own assets into an off-take vehicle. AUM, or rather I would say FAUM, fund assets under management. We are now at about 75 billion, including our REITs and our funds. We launched 2 discretionary funds. These are our first 2. Credo One China, US 550 million, as well as Cap One in first close of almost 400 million US dollars. Cap One is now deployed with 2 assets coming from the sponsor, Pufa and Inov Tower. ESG, very, very important part of our business. Not only the E, but also the S and the G. In terms of E, through Ascendas, we are going to install 6 solar farms on properties, or rather solar farms on 6 of our properties that will generate over 10,000 megawatt hours. This is far in excess of the electricity that these assets need. And what we would like to do is we will buy that green energy back into the CapitaLand ecosystem to further decarbonize our footprint. We inked our second sustainability loan of 300 million Singapore dollars. We now have 600 million of sustainability loans with our banking partners, and we will look to do more of the same. We launched a $500,000 CapitaLand UK Resilience and Enablement Fund for our less fortunate stakeholders. On the G side, we remain on the FTSE for Good for the 6th consecutive year, a testimony to our ongoing efforts on sustainability. And we won gold, very proud to have won gold for the Best Managed Board at the recent corporate awards. So from a thematic standpoint, our focus must be on leveraging the diversified portfolio that we have and capturing the full value chain of the capabilities in our core markets and our platforms. We have a deeply embedded NAV growth potential with the ASB portfolio. For example, in 80s vintage assets such as Science Park 1, we will look to focus on accelerating the ability to rejuvenate that portfolio. Disciplined asset recycling, as you saw, we are north of 3 billion on gross value recycled already to date. We will continue to drive that going forward. There are additional assets in our system that we can recycle. And focus on very much on execution on project milestones. In September, we will open Raffles City, Chongqing. We will launch an integrated development in Singapore in Sengkang, and we will start the construction of phase 2 of the ITP Gurgaon in India. And ESG will continue to remain a core part of everything that we do. So those are some of the key operational and strategic themes that I think are important to focus on. I'll now take you briefly through our financial highlights for 1H and 2Q. So 2Q, we were down on a PATMI basis of slightly over 4%. Now, looking past the number, the reason why principally we are down is that we decided to write off, we had to write off a full amount of $36 million, which are the acquisition-related expenses from the combination of ASB. If you strip out the 36 million, we were up year on year on a quarter basis. We had higher operating income from our investment properties. We had higher portfolio gains from our capital recycling, and we had higher operationally driven revaluation from our investment property portfolio. This was offset, as I said again, by the one-off expenses and by the timing effect of the residential handover from our properties in Vietnam and China. So overall for 2Q, we feel that we delivered a very credible set of results. And we're quite heartened by the resilience of the portfolio in the face of what is a very uncertain geopolitical environment. The 1H story is broadly the same, right? Of course, we don't have in 1Q, it was a residential timing issue, which I shared with you as well. A lot of this will catch up in the second half of the year, where our handover for Resi in China and Vietnam will come through. Okay, so here again, you see the comparative year-on-year for our three PATMI buckets. Portfolio gains at 135 for the year would have been 171, as you see, if we had not written off the 36 million in combination-related expenses. Revaluations, I will share with you in a bit, were higher year-on-year, but they're very operationally driven. And the operating PATMI was lower, as you see, again, because of the timing effect of the residential handover in China and Vietnam. On the revaluations side, what we've decided to show you is that of the $380 million of unrealized reval, these were the top 10 assets that contributed to that. And the contribution of these top 10 assets were roughly about 60% of that amount, of the 379. The average MPI yield on these top 10 assets increased year on year from 4.2% to 4.5%. So what we're trying to leave with you is that whatever revaluation we are recognizing on the book is performance driven. They are the result of higher NPI from a bulk of the properties that are being revalued. Of course, you do get market factors. There is some cap rate compression. There is also a fair bit of top-up revaluation, for example, with Funan. There's also some revaluation from the ongoing progress of our PUD, for example, Capital Spring and Shanghai on the Bund. So I think the key message here is this: yes, revaluation is up, but let's not forget our overall IP is larger, and at the same time, it is underpinned by performance-driven factors. The next two slides, I want to talk a little bit about capital recycling and the quality of that recycling and where it is going. So this is our divestments to date. So 3.4 billion gross divestment value year to date. Effective divestment value is a new number we are sharing with you. So CapitaLand's net benefit from this is 2.5 billion year to date. Now the assets in blue are the assets that are coming off balance sheet. So this is the full effect of our cleaning up non-core assets and ideally getting them into our REITs and our funds. So you see some of these are non-core, some of these have gone to our REITs and our funds. Of the 3.4 billion announced year to date, 1.2 billion has been completed as of the first half. So the key message here is that there is embedded net proceeds coming back to CL in the second half, which means that there is an embedded net deleveraging effect that is coming back to CL in the second half. The other side of the coin is our investment. So where is the capital going? Again, gross investment value of 3.3 billion. Our effective investment value is 1.3 billion. So on a net basis, we have put in 1.3 billion at the group level, which means on the right-hand side that the capital released to CapitaLand is 1.3 billion. Okay, so this has two effects. Again, there's a deleveraging effect depending on the capital structure, but also means that there is capital coming back to us which we can use for deployment opportunistically should the right opportunity arise, as Chee Koon talked about earlier. Crisis is also a time of opportunity, and we want to remain agile and be ready to deploy if the right opportunity comes up. The second thing I would like to leave with you is that, again, if you look at the assets in blue, these are the assets that have been acquired by our REITs and our funds. So we are doing exactly what we said we wanted to do. We want to take the assets and push them down into the logical owners, i.e. our REITs and our funds. In the process, we grew fund AUM by 1.7 billion. This is recurring fee income for CFL, CapitaLand Financial. On a balance sheet basis, the net debt to equity is a well-publicized number, 0.73. Our pro forma number when we announced Shine was 0.72. So I apologize, we came in slightly higher. But I think it's a number that we are comfortable with. As you saw from the activity levels that we talked about, we are looking and working very hard to get that deleveraging down. We are confident we will get to our target by the end of next year. Fixed rate debt at 64%, average debt maturity at 3.4 years are all numbers that we're quite comfortable with, especially the ICR, which remains healthy at 7.3 times. Some color on our look-through, which some of you are very focused on. If you look at our off-balance sheet funding structures, they're actually more conservative than our on-balance sheet funding structures. So please take comfort that our off-balance sheet funding remains very conservative. Debt towers are nice and even. We will look to further term out the debt as and when the right opportunity arises. As well, we have ample cash and committed facilities on hand to service the debt that remains on our balance sheet. Average interest rates at 3.2 have remained very steady now for 3 years. And in the current interest rate environment, we see the ability to perhaps even bring that down lower or keep the cost steady, but we term out loan maturity. So again, just to finish up, financial takeaways. Cash PATMI levels are healthy, 57% versus 61% a year ago. We believe that the quality of the PATMI is strong. We have high portfolio gains, we have stronger operating income coming from our investment properties, and our unrealized revaluation is underpinned by performance-driven factors. We continue to be very focused on unlocking capital through recycling, and wherever we feel we can, we recycle into our REITs and our funds, because at the same time we grow fee income, which is very, very recurring in nature, very, very equity accretive in nature. We are very focused on bringing deleveraging, deleveraging remains a key focus for us. Notwithstanding where we are today, we retain ample debt headroom to be opportunistic if the right opportunity comes along. Okay, with that, I hope that answers most of your questions, but I'm sure you have many more, and the CMC will be more than happy to take your questions. Thank you very much.
Okay, thank you, Andrew. And may I invite the key members of our senior management team up on stage for the Q&A? They need no introduction, but I will still do so. So, firstly, we have Mr. Jason Liao, he's President of Singapore and International. Mr. Lucas Low, President in China. And we have our Group CEO, Chee Koon, Group CFO, Andrew. And last but not least, I told him I would do that. Last but not least, we will have the newest member to our CMC, our senior management team, Mr. Jonathan Yap, who's just joined us from Ascendus. Jonathan Yap holds the position of President managing CapitaLand Financial. And just before we start, just a reminder to our webcast audience, you can send us your questions via the post question tab and we'll respond to that. And with that, I would like to open the floor for the first question. David Lam from Daiwa. Oh, sorry. So we have David first, and then we will have Derek. Oh, and just a reminder that if you could just state your name and your company for the benefit of our webcast audience, and just raise your hands if you have a question, and our ushers will pass you the mic. So I'll have David Lam from Daiwa for the first question.
Thank you. Good morning. With regard to Andrew's comment on divestments, given that you've done so much in the first half, do you have any guidance for the second half of the year? And it seems also like you've managed to divest a lot of non-core assets from the CapitaLand portfolio. Are there any underperforming assets left to divest? And should we expect most of the divestments going forward from the ASB portfolio?
We will continue to look at divestment. I mean, with the combined portfolio between the Ascendus, Singbridge and CapitaLand, give us a greater optionality. When we look at divestment, we look at, I would say that I use 3 buckets to look at how we manage recycling. First bucket, really non-core. So those were mentioned, the Store Hub, CCRE, Mubadala. There are probably a handful others. That's something that we're working hard. But just to be clear, Capital, we are not desperate sellers. There's no need to sell when, if you cannot get a good price. So we'll continue to look at doing deals in a manner that will be meaningful to CapitaLand. I mean, if you look at the way CCRE is structured, I mean, it's done at the price that's above the traded price. So that took time to negotiate. And the second bucket in terms of divestment will be assets that are already stabilized. There's no need to sit on CL's balance sheet. And we think that the right vehicles to hold these assets will be in the REITs. And that's something that you will see us very focused at looking at, continue to look at the recycling opportunities. Because what we want to do is to make sure that we meaningfully deploy CapitaLand's balance sheet to achieve that level of returns, to hit that returns requirement for CL shareholders. The third bucket of assets will be those that are still in the ramp-up stage, that just turned operational, that we just bought. There's still a lot of asset enhancement work to be done, and you will see us doing a lot to unlock value on this area here and to move them into bucket 2, ready for divestments. Yeah, so that's what I want to highlight. If you take a step back, if you look at the whole portfolio, there are, whether it's China, Singapore, India, Vietnam, and around the world, there are many opportunities. Singapore especially, there are interesting portfolio where we can do a lot of rejuvenation, as the Singapore government is looking to rejuvenate the whole country. And it's important to have a dialogue. I mean, Funan, Old Mall, we had a dialogue with the government, managed to intensify the GFA, create a product, and you will see us looking at suitable opportunities to look at unlocking value in our existing portfolio as well. Thanks.
And I think Derek from DBS, the next question, please.
Hi, good morning. If I may just follow up on David's question. Just wondering, based on your divestments pace, right, do you think you will hit your target of 0.64, the debt to equity, earlier than the end of 2020, based on your pace?
We'd love to. The pace is higher, so we are actually ahead of plan in terms of where we are today. If we can continue this pace, I think we have a good shot at getting that ahead of schedule. But I don't want to jump the gun. Okay, obviously, it's going to be very dependent on finding the right buyer. As Chikun mentioned, we are not distressed sellers by any means. So we will only divest when we find a right exit price, as you can see from the portfolio gains we have registered as of first half. Right? These are higher than we were when they were registered on a dollar basis year on year. So it has to be the right time to divest, but we remain very incentivized to accelerate as quickly as possible.
Okay, if I can ask just a couple more questions. Previously, you provided some form of pro forma for us to understand how you can potentially hit 10% based on what you're seeing and the latest numbers that you see on ASB. Are we on track to meet or beat that?
We are on track to deliver a return above our cost of equity. Derek, the annualized ROE for first half is going to be a function of just the CL P&L, right? So remember that the second half is where we get to enjoy the combination benefits on the P&L side. But on the equity side, remember we have issued 3 billion of new equity, half of which is counted towards the equity base. So if you will, the ROE number today, I would say is conservative because we don't get the P&L, we get the second half P&L, but the equity base already showing half of that impact from the additional equity we issued to Temasek. So we remain confident overall that we will get to a number that is in keeping with our target.
Okay, thank you. Last question. I mean, the group has been very decisive in terms of combination of Ascot and Ascendus. Just wondering whether should we think out of the box with regards to whatever you have currently in the listed platforms?
Yes, I think you should continue to take the mindset. There are no sacred cows. We can have, we are open to innovative ideas. The important thing, whatever actions that we are exploring, is to build long-term capabilities and competitiveness for the company. Yeah, that's what we'll be focusing on.
Okay, thank you.
Okay, Donald? Donald from BAML, right in the middle.
Sorry.
Oh, sorry. Okay.
Wi-Fi from UBS.
Wi-Fi.
I have a few questions pertaining to your retail portfolio. Maybe the first one, can you provide some color for your China retail sales? The growth slowed quite meaningfully and was negative in tier 1 cities. CRCT portfolio, I think it was positive, so what was dragging it down? That was my first question. Second question on rent reversion in China. I think you provided a number for office. Can you provide a number for retail as well? And for Jewel Changi, are you able to share the reval gain for the mall, as in the gain on top of your development costs? Thanks.
Let Lucas take the first question on China and Jason to talk about Jewel.
Yeah, I think for the retail in China, I think overall the portfolio we're still seeing the growth, as you can see from Andrew's number earlier on, in terms of tenant sales, in terms of traffic growth, even in terms of rental reversion for first half, we are seeing a growth. But if you segment it to the tier 1 city, I think the growth is affected by one or two of the mall, and particularly the Raffles City Shanghai. The Raffles City Shanghai actually all along has been enjoying a very high tenant sales. But because of the recent, some of the repositioning and all that, it has affected. But I don't think you should read too much to that slight negative number that is showing now. I think it's there's still a long queue in terms of the retailer trying to come into Raffles City Shanghai. So we are not too overly concerned at all. As a whole of the portfolio, I think we are still seeing positive rental reversion in the first half of 2019. And we should continue to see the outlook as fairly positive, at least for the rest of the year and the year ahead. Of course, for the big event coming up will be the opening of the Raffles City Chongqing retail mall. It's expected to be open in the early part of September. So we have announced recently that we already committed 95% occupancy. I think of that, it can increase another 1%. So I think we are positive on that mall as well as it open. So that will be the third major opening of a shopping mall weighing our CapitaLand portfolio after Jewel and Funan. That will be the big third one. Yeah.
So just on Jewel, We opened actually in April this year, and we have been very encouraged by the reception that we got from both the local and the international travelers. Everybody who has been there are actually wowed by what they saw. On the valuation, I think we are just only open for 4 months. We have kept it to the costs that we have incurred. I think it's early days, but having said that, the valuation is supported by the NPI that we are achieving today. So we have not done any valuation uplift on the property.
Just to add on, just share a bit more perspective on the retail scene in China. China as an economy is quite different from the rest of the world. More than 1 billion population, very entrepreneurial. In fact, when Alibaba started the e-commerce platform, it created this whole platform for many people who wanted to set up shops. They don't have the ability to go and rent a shop in the shopping malls. They set up shops online. And after they have become successful, many of them seek to move their successful business from the online into the shopping malls. And we, being one of the early entrants into the shopping mall business in China, we are actually benefiting from a lot of them coming to our malls. There are innovative concepts from bookstores to, different types of products from really from online to offline. And we are seeing that in China. I think that's a very, very different type of retail scene in China as compared to the rest of the world.
Okay, I think that's Donald from BAML.
Hi, this is Donald from BAML. I have a couple of questions. The first one is on your fund fees. I'm looking at the EBIT from your CL financials. You've been running at about 51% EBIT margin for the last 2 quarters. This is considerably lower than the last year, which is running at 63, 64%. So I'm wondering, even as your FUM rises, why is your fund fees coming down for 2 consecutive quarters? That's my first question. The second question is also on recycling. As you deleverage faster than expected, should we be expecting more reinvestments in the second half than divestments? And if it's, where are we looking at in terms of buying into? Is it more IP or DP? And which areas are we looking at? The last question is on Liang Court. Any guidance on what's the plan for this acquisition or this purchase recently? Thanks.
I'll take the first question on FAUM fees. FAUM. So there are 2 effects here. One is our FAUM is larger, okay, as of today, but we haven't earned the fees yet. The fees are going to come in the second half of the year as they are in the portfolio. So the first half reported fee income does not include the Ascendas REITs and funds, but we are reporting as of today the balance sheet of 70 or AUM or FAUM of 75 billion. So you will see that it may, on a percentage basis, look smaller. Then on a transactional level, even though the recycling has come up, a lot of them have not yet closed. So our REIT managers have not yet recorded the acquisitions or divestment fees that will show up when these transactions close. A lot of the 3.5 billion are announced divestments, announced acquisitions. They haven't yet closed, which is when we book the fees. So my guidance is probably ask this question at the second half of the year, the end of the year, and let's have a good look to see what it looks like once we have the Ascendas REITs and funds into the portfolio. Margins, I think, again, are a function of the one-offs as well, because we include the one-off acquisition divestment fees. The base fees shouldn't change. In fact, you're right. As AUM goes up, if my base fee is the same, then all things being equal, we should be recording higher fees. There's no reason for lower fees.
Okay. And I thought I would take a question from Tan Chuan Xiao SA. Sorry, one more question.
3 questions.
Oh, sorry.
Ask
Please,
for Liang
Jason.
Court. I think Liang Court, we have recently completed the acquisition of the mall together with CDL. So it's a 50-50 acquisition. I think the immediate focus is really to make sure that the retailers continue to trade well. I think as to whether we have any redevelopment plan, I think if you look at the whole Liang Court, it's an integrated development comprising of Novotel, which is owned by CDL Hospitality Trust, and Somerset Liangkok, which is owned by ART. So if there's any redevelopment opportunity, it has to be done together with the other two trusts. Yeah. So I think it's too early to talk about that one. Yes.
In terms of investments, I mentioned earlier, we always look for deals that will be accretive, that makes that can build long-term profits and growth drivers for the company. So if we, for instance, we want to continue to deploy capital in India, logistics, business park. I mean, if we can, the issue is whether we can find good land. If we can find good land, that's something we want to do. So we'll continue to look for interesting development opportunity, but land cost is extremely important because we important that we get the land cost at a good price so that we can really make sure that we build the long-term earnings profile for the company. In terms of investment properties, we will continue to look at it. That is not so easy because things are extremely expensive. That's not for lack of trying. So we will, of course, we hope to be able to invest as quickly as we can, but well, it depends on the opportunities at the end of the day. Thanks.
Okay, I think before I take the question from our webcast audience, I'll give an opportunity to our media, our friends from the media. Do you have any questions from this side? Okay, Gula, please pass the mic to Ms. Gula, please.
Yeah, sorry, Gula from The Edge. I just wondered, of the divestments, how much have you reported in your first half, and how much is left to be reported? Because just wondering on the gearing level whether it'll drop in the second half.
I think the gross value on the first half basis of divestments was somewhere around 2.5 billion out of the 3.4 billion year to date, Gula. Out of that, I think we've completed 1.2 billion year to date. That's again on a gross value basis. So there is embedded proceeds to come, which should mean that there's embedded deleveraging to come. Does that answer your question? Thank you.
We have one more question over here, right?
One more question. And were there any gains from the divestments? Because I do realize your CCRE had quite a good gain. I wonder if you could give some color on that. And also the Middle East, the Mubadala thing. And did you also divest Rihan? Is that still on your books, or is that also gone?
Rihan is gone. Rihan is part of the Mubadala trade sale. Both CCRE and Mubadala were divested, not at a loss, but also not at a substantial gain either. So those were more focus points to get off non-core assets and recycle that capital into more productive uses. In terms of the overall gains, that is reflected in the one half portfolio gain number, which I believe was 135, 171 if you take out the 36 million.
Question from gentleman.
All right, I'm Kevin from Nikkei. Two questions. You talked about diversification in a period of uncertainty. That being the case, are there like plans to perhaps lower your reliance on China and Singapore going forward? And second, can you just give a broad comment on how you see developments in China, given the worsening trade war and slowdown in economic growth? Thanks.
I think China second quarter still growing at 6.2%. So being a second largest economy in the world, growing at 6%, I think is quite a reasonable growth rate. Of course, it's lower than originally expected and all that kind of things. I think the trade war we can see it in a different perspective. One is that, of course, the export industry that having trade with the war and some of the financial market currency and all that are affected. But I think in terms of the domestic demand, whether is it demand for residential or demand from consumer in terms of consumption within China itself, I think the retail number has shown that is still on a positive outlook side. I think just now Chikun also has said that the retail scene in China is very, very different compared to another major economy in the US, where you see a lot of the big store retailer all are shutting down and all that. But I suppose for China, in view of the population, in view of the density of city living and all that, the fact that the home are not as comfortable as our US counterpart, where each of them live in a very luxurious, bigger home. So people need to get out of their house, need to have a place to socialize and all that. I think that has been driving the retail scene. Of course, as part of the trade war or trade tension and all that, there are policy also to pump prime the economy or the demand within China itself. So as a result of that, I will still see that perhaps in terms of the domestic consumption, the domestic economy within China itself, being a big continent economy, will still continue to do well. Even if it's slowed down to probably 6% or even 5+% going forward, if that's the case, we will still expect that there will be certain level of impact, but as a whole, our business in China will still continue to grow. As for the residential, the key thing is that there's still a lot of upgrade demand as well as the real first-time demand that has not been fully met. So despite the bit of uncertainty as a result of the economic situation, we're still seeing good demand from the launches that we have launched. We have a sell-through rate. For those that we launched in the first half of the year, sell-through is slightly more than 80%. As a whole, for those that we have already launched, our sales rate is at 94%. So actually, to me, I have not enough stock to sell. Not so much as I have unsold stock that in view of the lower demand and all that kind of things. I think the other thing to give comfort to all is that there's still some policy in terms of price control in some of the city that we are in terms of the residential selling price. I would say that based on all these current price control selling price now, almost all our projects are in the money. It's a question of whether I can raise the selling price more to make a better profit margin for us. Otherwise, if I choose to sell it at today's controlled price, we are still in the money. So that will be the comfort that I can give all in terms of our residential portfolio now in China.
I think we have one more question from this side.
Hi, Kang Wei from...
So the other question on China and Singapore, when we announced the merger with Ascender Singbridge, we stressed that the idea of the transaction is really to create a more geographically diversified portfolio across different markets and different asset classes. I also mentioned that the 4 key markets where we are fully integrated will be Singapore, China, Vietnam, and India. So this will be the 4 core markets that we will be vertically integrated. China will continue to be very important in CapitaLand's business, and it is the single largest market for us, and there are a lot of opportunities that we can do. But we don't need to use all of, there are many other capital partners that we can work with to continue to grow our business in China. On Singapore, I have mentioned earlier in the past, CapitaLand only used to do residential, retail and office. And now with putting together Ascender's Singbridge portfolio where you have industrial, logistics and business parks. And development in Singapore, development risk in Singapore is something that I think we can handle. And we have good takeout vehicles for all the different asset classes. I think Singapore will be quite interesting in terms of rejuvenation play in the next few years for our portfolio. So that's something that we hope to be able to share with you when we are more ready.
Okay.
Hi, Kang Wei from Lianhe Caobao here. Quick 2 questions, same on China and Singapore. I'm just wondering what's the short-term impact of the yuan depreciation on your China portfolio? And also on the Singapore market, what's your current reading now since a year after the cooling measures were implemented? Thank you.
Sorry, what was your second question?
What's your current reading for the local property market after the cooling measures were implemented?
Okay, so I'll talk a little bit about the yuan. So yes, yuan is past 7 to the US dollar first time since 2008, I believe. I think we've already seen some of the retracing coming back. The Chinese government has come out to say that it is not part of a wider strategy to weaken the yuan. So that is helping the markets. And this is all very sentiment driven. In terms of where we are as a business, so the fundamental philosophies are as follows, right? We always naturally hedge our foreign currency exposure as much as possible by taking out local currency loans. For the equity that we have to put in, which is Sing dollar based, then we obviously will have an exposure to that. Now that exposure is limited again because we try to naturally hedge as much as possible, and to the extent that it stays on the balance sheet, it does not come back to the P&L. So we've done some analysis, and for every 1% depreciation of the RMB, the P&L only takes about a 0.6% hit based on translation of RMB coming back to Sing dollar. On the balance sheet basis, 1% depreciation in RMB currently impacts our equity by about 0.3%. So there's a very strong natural mitigant based on the natural hedge that we have put in place. I hope that answers your question.
I think on the residential side, we remain very cautious and disciplined in the way we look at residential in Singapore. If you recall, in the last few years, we've been de-risking our residential portfolio. So if you look at the old portfolio, today we only have one unit left in the entire, that was before One Per Bank was launched. So we are also very encouraged by One Per Bank. I think it's got a lot of unique selling point. Besides the location, we also have a very good design, functional, and a product that we think is very well received by the market. So we remain very cautious, but at the same time, we want to be able to be quite opportunistic about this residential sector in Singapore.
Okay, I think we have time for 2 questions. I just need to go to my webcast audience. I'll come back to you. So Tan Chuan Xiao SA, her question is, can you share what will net gearing be once all the remaining divestment proceeds come in? Is 0.64 a moving net gearing target? What she's asking is, if there are more acquisition opportunities in crisis, will you look to either divest more or to potentially change near-term gearing target? Question for Andrew.
Okay. It's a difficult question to answer. The answer in short is yes. If we had a very good acquisition opportunity, obviously things are dynamic, things are fluid. We may look to, if it's a very substantial acquisition, we may look to finance some of that with additional divestments of assets that perhaps were not immediately on the horizon. So you have to allow for this fluidity and the ability for management to react in real time to take place. As it stands today, we remain focused on getting that deleveraging in place. We think we will get there by end of next year. As I shared earlier, we are ahead of plan as we speak, based on the proceeds that we have already raised to date, and we are focused on continuing on that momentum. So I see no reason why, all things being equal, we don't get there ahead of time. And if we get there ahead of time, then it means we have more headroom to allow us to evaluate interesting opportunities that may come up.
And our colleague over here, the next question.
Hi, Cheryl from CNA here. I just wanted to ask about the Singapore property market specifically. So apart from One Pearl Bank and the site at Sengkang Central, so how's your current land bank looking? Is it like you said, you're kind of just holding out for good opportunities, or is there a sort of bigger sense of urgency right now? And any concerns as well that the global uncertainty will weigh on that?
I think like Chiku mentioned, now with ASB combination, we actually have quite a big exposure in Singapore. The last count I did was we have 156 properties in Singapore, big and small, about 4.4 million square meter of GFA. And this is a combination of both industrial properties, logistic, residential, offices and all that. So I think there are a lot of things that we can look at in Singapore across asset classes. So like for example, we have quite a lot of exposure in the Jurong Precinct. We have quite a lot of exposure in the One North area, where we can actually relook at the portfolio composition and see what we can do with all this precinct. So I think beyond residential, I think there are actually quite a lot of development opportunities within the portfolio now. Yeah.
Okay, Brandon.
Yeah, hi. Brandon from Citi. Just two questions from my end. The first one is with regards to divestments. Let's say if you manage to hit past your targeted amount, how open are you to looking at, say, a share buyback or let's say a higher dividend payout? Yeah. That's my first question. Second question would be, where would you put CMMT, Korean office, and Japan retail within your bucket, the three buckets that you mentioned? Yeah, thanks.
You want to take this? Question number one is dividends and buybacks. They remain in our toolkit, and then we always, again, our two rules of thumb for buybacks, excess cash and a belief that our shares are undervalued. The second is definitely true. Currently, I would say that maybe excess cash is perhaps not so prevalent right now. And if I had excess cash, then the right thing to do really is to pay down debt. So to take that away, the priority right now is less on share buybacks, but now on getting the deleveraging in place. It's a net debt to equity number, so it includes cash as well. So if we can get there, then I think we have this ability to think about share buybacks, assuming the stock market doesn't fully buy into what we are trying to accomplish. That's question number one, I think.
Your specific questions on Japan, Korea, and CMMT. I think the way to look at it is we look at asset or country. We ask ourselves whether any specific asset class in the country, whether we can build scale, whether we can be competitive, whether we can grow the portfolio significantly that can contribute, make interesting contributions to CapitaLand's bottom line. If not, then we need to review. So I think that's my answer to you because, going into the specifics are always complexities. So I hope that should guide you in terms of how we take, it's a very disciplined approach that we take, regardless of markets, regardless of asset class. Yeah.
Okay, as you can see, the shops are opening and the coffee machines are starting. So we're going to take two more questions. But before that, can I ask if anyone has questions for our newest member, Jonathan Yap, CFL? Okay, I thought we should get Jonathan to provide us with some broad thoughts on what he thinks of CFL, right? John?
Thank you, Grace. You're not going to let me go, right?
Yep.
Yeah. Looks like I've earned my keep for the morning. I heard some of the earlier questions, whether it's from Donna or Derek, around fund management, fee income, so on. I can totally understand where that's coming from. I just want to reiterate what Andrew just said. In fact, both Andrew and I would discuss whether or not we're rush through this quarter to give you more visibility on the ASB side of things, as well as other plans on the fund front. But the truth is, until the quarter ended, ASB information is not publicly available, so therefore we do have some restriction in terms of how far we can share them. But we also want to make sure that we want to put information in a manner that's clear enough and consistent over time to allow you to build your models so that you don't have to kind of keep figuring out what we're doing. So hold your thought. I believe in 3Q you'll get more information, I'm sure. So at a point in time, probably you can have even more specific questions. We're happy to address them. But if I may just say, clearly coming to this job is exciting for me. At the same time, the question I asked when Chee Koon asked me whether I'll take the job is obviously, is there something we believe we can do with this platform? As you see today, we now have 129.1 billion worth of real estate asset under management. Fund AUM is around about 70 over billion Sing dollars. So it's actually a very big platform. So not only allow us to have scale, allow ourselves to hopefully visibility, accessibility to more capital, it also allow us to more efficiently use our listed trusts as an engine of growth. We'll do more on that, and not only from assets that we recycle from a balance sheet, but also potentially use those vehicles to basically compete for good assets. But at the same time, we will have to remain disciplined because ultimately, our unit holders in our REITs invest for profitability, so we have to take a good balance between long-term and short-term consideration there. Secondly, in terms of private fund, I think that's a universe that we are probably a little bit underrepresented. vis-a-vis where the global scale is in that business. That's something we will be spending more time to work out what are things we could do. James Lim, who runs our discretionary fund, Cap One, and Source Credo is there. So I'm sure that's something we will do more. And third, I'll just end by saying that the question people always ask is how do we differentiate ourselves vis-a-vis our peers? I believe there are many ways of differentiating. Obviously, finding the right strategy is one. Sometimes it's also about how well we can execute. I think that's where we want to make sure that we not only are a good real estate manager, but also a good fund manager, effectively managing the capital, and how well we can integrate all those various skill sets under one roof in the most integrated and competitive manner. And I do think that's somewhere where we can do well, not only because we are established fund manager, we also have real estate property management experience, but also real estate development experience. It's rare to have that combination under one roof, and that's clearly an area we'll leverage a lot on. And Grace, thank you.
Thank you, John. Thank you. I would like to take the last question from Willard. He's joining us from Hong Kong through webcast. Willard just shared with me that he had a tear gas below his flat just 2 days ago. So I'm going to take his question, and I think it's a very good way to end. So Willard asks, CapitaLand traditionally do not have any exposure to the logistics sector. So with the ASV acquisition, now you have some logistics. How much resources will you commit to grow your logistics exposure in the next 5 years? Is this part of your effort to become more diversified and more resilient to global uncertainties? Maybe Chee-Kun would take the last question.
Right.
Giving a chance to Jonathan.
Yes. Clearly, I guess in Andrew's presentation earlier, you saw how with the combination we have diversified beyond our traditional classes of retail and residential. Logistics clearly is something that we want to do more, and not just because of diversification, but also the synergistic benefits that we see logistics across the other sector that we are in. So we do have customers, for instance, are in our business parks and our office. They do have logistics requirement. And more importantly, even for our retail customers, they also have logistics requirement. So clearly from our perspective, not only because the macro are in the right direction, but we do believe there are synergistic benefits in growing that segment. And clearly we have tried to do quite a few things. In Singapore, we have some logistics presence. In India, we have entered logistics, both in terms of completed assets as well as income producing, and clearly it's a sector we certainly want to do more and leverage more on the synergistic benefits that the whole entire combination of the portfolio will give us, and it goes way beyond just diversification.
Okay, thank you, John. And with that, I think we will end this briefing. Thank you all for making way of here to Funan, sitting on the stairs, our first fireside chat, and we hope to have more of this going forward. And we will be around, the management will be around if you have more questions, and please stay around for mingling and perhaps some shopping later. Thank you. Have a good day.